What's up, you guys? It's Nick here with another company overview video. And today we'll be talking about one of my favorite companies in S&P, NextEra Energy. I know some of you may be not too eager to look into a utility, but take a look at this chart. NextEra Energy is in blue, and you can see that the company outperformed S&P by over 60% during the last 3 years. S&P is in red. And it also outperformed one of the best sectors in S&P, which is technology. So if I got your attention, here's how this video is gonna go. First, we'll be discussing the macro trends in the energy sector. Second, we'll explain how the company is positioned to capitalize on those macro trends. Third, we'll highlight the company structure, because whenever you buy in NextEra, you really buy in 3 or 5 different companies, and I think it's super important to understand it. And lastly, we'll be discussing the company financials, valuation, my target price for the company, and compare it to the analysts. So if you want to stick around for the full show, feel free to do it. If you want to jump around to a specific section, they're going to be down below in the comment. And with that, let's roll the intro. The conversation about NextEra has to start with the overall outlook on the energy sector. And even though NextEra is classified as a utility, it's really an energy company of the future. So let's take a look at the forecast. And for that, let's go to the EIA website. EIA publishes the annual energy outlook, where it discusses the major trends that are going to happen in the next decade or even 3 decades at some point. And it's a very lengthy report that you can see here based on this 100 pages. And for anyone who is interested, I will link this report down below. But let's focus on the 3 major trends that I find the most important and the most interesting. Trend number 1. The future is renewable. And no, I don't say it just because I'm a millennial and I want to believe in this renewable future. I say it because I truly believe in efficient markets, and renewables are the cheapest source of energy that exists today. If you take a look at this graph from Lazard, which is another great resource to use for the energy geeks out there, you'll see that solar and wind are the cheapest sources of energy if you look at the unsubsidized levelized cost of energy. And you may ask, Nick, what is the unsubsidized levelized cost of energy? Well, I don't think I have to explain what unsubsidized means, but what the levelized cost of energy are, it's really the overall costs that go into the development of the project and operation of the project divided by the cumulative energy output. So you basically get the dollar divided by kilowatts, and that's the cost of energy. This is a very good metric to use for comparing different types of projects like compressed natural gas or gas turbine projects with solar, wind, etc. So based on this metric, solar and wind are the cheapest, and then it's closely followed by gas combined cycle turbines, and then there comes coal, nuclear, etc. But because of this cost of energy, EIA forecasted that by 2050, renewables is going to capture 38% of the electricity markets. And that's why the energy company of tomorrow will have to find the ways to transition to more renewables in order to capitalize on this growth perspective. Trend number 2, cheap natural gas. We cannot deny that natural gas is going to be as dominant in the future as renewables. Again, it's cheap, so it will continue to grow. Take a look at this graph from EIA, and you can see that the production of natural gas is going to be much more dominant than any other source of energy by 2050. So the companies of tomorrow will have to find the ways to capitalize on this growth potential and take advantage of the cheap natural gas. I know that some of you may say that, Nick, natural gas is not renewable, so how it can grow if politicians will try to kill it, blah, blah, blah. And I'll agree with you that most of natural gas is not renewable. But there's also landfill gas, and there's also my favorite dairy gas, which is really you collecting the methane from the atmosphere whenever cows poop, pretty much. And that is even better than producing renewables, because you're taking the greenhouse gases from the atmosphere. And as a result, the natural gas can be renewable. So my point is, we as investors have to take the unbiased perspective on it and just see what companies are positioned to take advantage of this undisputable fact, pretty much. Trend number 3. Energy consumption per capita will be flat or decrease over the next decade. And that makes perfect sense to me because of increasing efficiencies of diesel and gasoline engines, and also think about all the light bulbs that people put in their houses. It may not seem like too much by itself, but in aggregate, it really adds up to a big deal. So the companies of tomorrow They'll have to find alternative ways to sell power or fuel in order to capture the growth potential that they're promising, or in order to just stay in business. So these are the three trends that are going to dominate in the energy industry, and the successful company of tomorrow will have to capitalize on those. The next question is, how does NextEra position to capture these long-term trends? Well, speaking about renewables, NextEra is a dominant force in the renewable space. They have more renewable energy projects than any other company in the United States for sure, and maybe in the entire world. And that's been in the core of the company since the beginning. If you look at the map of the project, they almost in every single state in the United States. So I think from the renewable perspective, they're pretty covered there. In addition, they constantly trade in those renewable energy certificates, which I can't get in too much of details in here. And if you guys are interested in it and how it benefits the bottom line for NextEra or any other companies like Tesla, leave a comment down below and we'll be talking about it in the following videos. But my point is, from a renewable perspective, NextEra is really capitalizing on the market, and it's been in the core of the company for a while now. The second point is about the natural gas, and NextEra is actually one of the largest producers of power from natural gas. In addition, they own and operate the pipelines in Texas and some other states where they basically transport natural gas from one location to another, and that's called midstream in energy, and that is exactly the spot where you want to be, because if you're in midstream, you're not really exposed to the volatility of commodity of products that you ship in. You're really just winning whenever the volume of the product is increasing. And if you look at the chart that I have showed you in the beginning, the volume of natural gas is going to really increase in United States, and that's why I think NextEra is also positioned well to capture this growth of cheap natural gas trend. The third point is about decreasing energy consumption per capita and alternative ways for the company to invest. One thing that I can tell for sure is that NextEra is not scared to innovate. They've been one of the first companies to get into energy storage, and that's just been a hugely successful move for them, because now they have over 200 megawatts of power, and that not only benefit their bottom line, but it also allows them to put projects into technically difficult areas on the grid where there is a congestion of power, and by putting energy storage on there, they're basically able to create new project opportunities and also decrease the overall cost of the project. In addition, if you listen to their last quarterly call, you'll hear them talking about hydrogen and how they're starting out to pilot some technology. It is a very smart move for the company, because hydrogen will require a lot of energy. And if you want to learn more about my perspective on hydrogen, you can follow our previous discussion with Sean about Nikola, where we get into details about hydrogen and how much power it will require in order to be produced from the renewable sources. Anyway, by getting to hydrogen, NextEra can really increase the sales of electricity dramatically, and that will well compensate for the decrease in consumption per capita that you can see generally in the market. For those three reasons, I strongly believe that NextEra is positioned very well to capitalize on these long-term trends, and they're going to be one of the major forces in the energy industry in the future. Now, let's switch gears a little bit and talk about the NextEra Energy company structure. You can see the graph right there. As I said in the beginning, there are 3 or 5 businesses that NextEra Energy owns and operates. The first one that I want to highlight is FPL, or Florida Lights and Power. It's a regulated utility in Florida that serves about half of residential electric accounts. Huge influence in the state. The company brings about 63% of total NextEra Energy revenue based on the 2019 10K, which equates about $12 billion. Of course, it's a regulated utility, so it has a low growth perspective, but it's a big chunk of their business. Because it's a regulated utility, it's really hard for them to expand to different states and build the project somewhere in the middle of the country. And that's why they created a separate entity that's called NextEra Energy Resources. This subsidiary owns, operates, and develops different energy projects around the country, and basically makes margin on those projects and sells it either to different third-party entities or keeps it within NextEra. NextEra Energy Resources really helped NextEra to have this national footprint, and as you can see on the map, really have almost at least one project in every single state. It brings about 30% to the top line revenue, or about $5.6 billion, and it has a very high growth perspective. This is the main business line that I'm most bullish about within NextEra, and I think it's going to be a core component of NextEra's success going forward. The third subsidiary that I want to point out is Gulf Power. That is also a regulated utility in Florida that NextEra bought just a year ago. It brings about 7% or $1.4 billion to the top line of NextEra, so it's substantially less than the other two. But I think it also has some growth perspective to the bottom line, because NextEra has a good history of improving the operational efficiencies of the utilities, and I think it can yield a pretty good return for the shareholders at the end. Again, being a regulated utility, it's not too much of growth perspective, but I think it's a good strategic move for NextEra to improve the influences within Florida electric power space. You may ask, why NextEra not trying to acquire utilities in other states? Well, again, utilities are very difficult and regulated business, and they actually tried to acquire a company in Texas back in 2017 for about $18 billion. But regulators in Texas didn't allow the acquisition to go through because they were worried about the ratepayer increases, and as a result, basically the company wasted a few years in negotiation. As of right now, they don't really look into expand to Texas, as far as I know, and they haven't published any information about expanding to different utility regions as well. The last part of NextEra that I want to highlight is NextEra Energy Partners, which technically is a separate company, and it's traded under its own symbol, NEP. The company owns and operates the long-term energy contracts, or PPA, if you're familiar with it. Basically, that's a cash instrument where companies or different people agreeing to purchase power over a long term, and that locks in the stable cash flows for the owner of the projects. In short, really like the structure, and a lot of pension funds invest in this type of assets, and that's a big portion of what NextEra Energy Partners has. Basically, this long-term power purchasing agreement. There's also about 25% of the company that is exposed to natural gas, and they all own and operate pipelines, which again, I think it's only a benefit because we're talking about natural gas pipelines. And the main reason why I like NextEra Partners more than anything under NextEra umbrella is their dividend yield. If you compare the dividend yield of NextEra and NextEra Energy Partners here on the graph, you'll see that NextEra Partners has basically double of a dividend yield. Of course, all the high yields always come with the higher risks, but I think being under any umbrella and having the backing of NextEra Energy, it's really hard for me to imagine a scenario where NEE would allow NextEra Partners to fail. And for me, the risk is justified, and that's why I proposed this company to our endowment, and we purchased it back in 2018. I guess the point is, really like this company, and if you're looking to build the dividend yielding portfolio, that could be a good investment, and I really suggest you taking a deeper look in it and don't take my word for it. So, in short, this is the structure of NextEra Partners. I've skipped several subsidiaries for the time's sake of it, but we'll probably discuss them in a Q&A video. Now, when you understand how the company is structured, let's talk about financials. If you stick all the way to the end, you like finance as much as we do, and that's why we're going to get a little technical here. Of course, there is a lot of metrics that we could look at, like the leverage ratio, the credit ratings, the interest expenses, and all of those things. But instead of taking 2 hours of your time and mention all the different metrics, I would much rather prefer you ask a question about a specific ratio that you're interested in, and I'll just focus on the metric that I like the most for the utilities, which is their dividend yield. As I mentioned earlier, the dividend yield for NextEra is 2.2%, and the industry standard for utilities in S&P is about 3.6%. So the dividend yield for NextEra is a little lower than the overall of the industry. While the yield is lower, the growth rate is higher. The growth rate for NextEra is 12%, and the growth rate for the industry is 8%. So I think overall it balances it all out. The payout ratio for NextEra is 70% and the sector is 69%, so again, it's pretty much in line. The other metrics that I like to look at specifically for NextEra is their capex versus dividend payout. The reason why I'm looking at it is because this company is really undergoing big expansion right now, and it spends a lot of money on the different projects. But of course, at some point in the future, there's going to be a saturation of renewable projects, and the capex that they currently spend on the expansion could go to either dividend payouts or cash buybacks, or stock buybacks, sorry. And that's why it just, it doesn't clearly say how much more the dividend could grow, but at least it just gives me the hint and verifies what should be my supernormal growth assumption be for the discount model. Instead of boring you with the different assumptions that I've made for the model to get to my target price, I'll just put them right there real quickly. And I also link the Excel document down below, so if you're interested, you can dig into it. In short, the target price for the company that I have is about $257, and it's currently traded at $280. The analyst estimate, or at least the estimate of analysts that I follow, is about $280, so it seems to be fairly valued or a little overvalued. And that's why, despite all of the stuff that I told you about how much I like this company and how well it is positioned for long term, I do think that right now it's a little overvalued. So I wouldn't get into the stock just yet. I would wait a little bit until there's going to be a better entry point and then buy a stock for long term. I do have some other concerns about the company, despite all the positive things that I mentioned. But if you want to know what concerns I have, you'll have to tune in to our Q&A session with Sean that we're going to post about a week or so. Also, if you have any questions, leave them down below. If you find this video helpful, please leave a like. It really helps us to go up in the searches, which means a whole lot to us. With that, thank you guys so much for watching, and we'll see you in the next one. Peace.